Market update. Equities stall as Amazon and Apple earnings awaited. As the excitement in the stock market begins to wane, investors are left pondering the implications of upcoming earnings reports from tech giants Amazon and Apple. Summary of market movements. Key companies. Microsoft and Meta see gains following their quarterly earnings reports. Semiconductor stocks experience a downturn. Recent economic data indicates a rise in inflation alongside a stable labor market. Major indexes show declines. Dow down 0.74%, S&P 500 down 0.37%, and Nasdaq down 0.37%. On July 31, 2025, U.S. stock markets closed lower as initial gains diminished. This shift followed the release of the latest corporate earnings and economic indicators, with investors eagerly awaiting the results from Amazon and Apple, which were set to be announced after the market closed. Microsoft's strong performance. Microsoft shares surged by 3.5% after the company reported impressive earnings, briefly pushing its market capitalization past the $4 trillion mark. This achievement made Microsoft only the second publicly traded company to reach this milestone, following NVIDIA. Meta's record high. Meta platform saw a remarkable increase of 11.3%, closing at a record high of $773.44. This surge was fueled by robust growth in its advertising business, driven by advancements in artificial intelligence, which led to an optimistic revenue forecast. Challenges for semiconductor stocks. Conversely, other companies in the AI sector faced challenges. Semiconductor manufacturers like Broadcom and NVIDIA saw declines of 2.9% and 0.8% respectively, contributing to a 3.1% drop in the PHLX Semiconductor Index, marking its largest daily decline since mid-April. Ellen Hazen, chief market strategist at FL Putnam Investment Management, noted, "Today's market reflects a divide between successful tech companies and those struggling, particularly among semiconductor and related equipment stocks. However, Microsoft, Amazon, and Meta are performing exceptionally well." Earnings reports overview. Out of the 297 S&P 500 companies that reported earnings by Thursday morning, an impressive 80.8% exceeded analyst expectations, a notable increase from the 76% beat rate observed over the previous 4 quarters. After the market closed, Amazon's shares fell by 2.6% in after-hours trading following its quarterly earnings report, which failed to impress investors. Index performance. The Dow Jones Industrial Average dropped by 330.30 points, or 0.74%, closing at 44,130.98. The S&P 500 lost 23.51 points, or 0.37%, ending at 6,339.39. While the Nasdaq Composite decreased by 7.23 points, or 0.03%, to close at 21,122.45. Earlier in the session, both the S&P 500 and Nasdaq had shown promise, with the SP rising as much as 1% and the Nasdaq climbing 1.5%. Notably, the Nasdaq has not experienced a movement of at least 1% in either direction since July 3rd, and the SP last recorded such a move on June 24th. Economic indicators. Recent data from the Commerce Department revealed an uptick in inflation for June, attributed to new tariffs that have increased prices and raised concerns about potential future price pressures. Additionally, weekly initial jobless claims indicated that the labor market remains stable. Investors are now looking ahead to Friday's non-farm payrolls report and a looming tariff deadline, as President Trump is expected to announce higher final duty rates for countries that have not reached agreements. Although Mexico has received a 90-day reprieve, U.S. stocks have rebounded after a significant sell-off that began in early April when Trump announced a series of steep tariffs. But the market has since recovered, as agreements have been made with various trading partners regarding duty levels. For the month of July, the S&P 500 saw a gain of 2.17%, the Nasdaq increased by 3.7%, and the Dow rose by 0.08%, marking the third consecutive monthly gain for all 3 indexes. Pharmaceutical sector declines. The pharmaceutical sector also faced challenges after the White House announced that Trump had sent letters to the CEOs of 17 major pharmaceutical companies, urging them to take immediate action to reduce prescription drug prices for Americans. The NYSE Arca Pharmaceutical Index fell by 2.9%, marking its largest drop since May 14th, and the fourth consecutive session of declines. Overall, declining stocks outnumbered advancing ones by a ratio of 1.55 to 1 on the NYSE and 1.98 to 1 on the Nasdaq. The S&P 500 recorded 35 new 52-week highs and 28 new lows, while the Nasdaq Composite noted 70 new highs and 141 new lows. Trading volume on U.S. exchanges reached 19.65 billion shares, surpassing the average of 18.01 billion shares over the past 20 trading days. Final thoughts. As we reflect on these market movements, it raises important questions. Are we witnessing a temporary setback or a more significant shift in market dynamics? What are your thoughts on the performance of tech giants versus the struggles of semiconductor stocks? Share your opinions in the comments below. Meta and Microsoft surge. AI spending fuels earnings growth. The AI spending frenzy is reshaping tech titans' futures, but not everyone's convinced it's sustainable. Meta and Microsoft just delivered a masterclass in how artificial intelligence investments can turbocharge stock prices. But beneath the glowing earnings reports lies a heated debate about reckless spending versus visionary bets. Both tech giants saw shares surge Thursday, Meta skyrocketing 11%, Microsoft climbing 4% after smashing Wall Street predictions, fueled by what analysts are calling an AI infrastructure arms race. Here's where it gets controversial. While investors cheer today's profits, these companies are gambling billions on unproven AI capabilities that might not pay off for years, if ever. Let's break down the numbers fueling this high-stakes gamble. Meta now plans to spend up to $72 billion this year on AI infrastructure, $2 billion more than their lowest initial estimate. That's enough money to buy 12 space stations or fund NASA's annual budget 3 times over. Microsoft's even more aggressive, projecting over $30 billion in quarterly AI investments, nearly 25% higher than analysts expected. For perspective, that's like spending $333 million every single day on computer chips and data centers. But here's the twist most investors miss. This spending spree isn't just about the tech giants. Chip manufacturers like AMD and Broadcom are cleaning up as secondary winners, with Microsoft alone accounting for 8% of AMD's sales. It's creating a ripple effect across the entire tech ecosystem. But can this momentum last if AI adoption slows? The real drama unfolds in the executive suites. Mark Zuckerberg's going all in, dropping $14.3 billion to acquire data labeling startup Scale AI, and launching a superintelligence labs division. Meanwhile, Microsoft's Satya Nadella keeps quietly dominating cloud infrastructure, their Azure data centers now the backbone of countless AI tools. Analysts are torn. Morgan Stanley praises Meta's future-proofing efforts but warns, throwing money at AI talent like confetti at a parade might backfire spectacularly if these moonshot projects fail. Contrast this with Barclays' bullish take on Microsoft. They're not just riding the AI wave. Verity ocean it's flowing through. The financial results speak volumes. Microsoft's Q4 revenue hit $76.44 billion, up 18% YoY, while Meta's $47.52 billion Q2, 22% growth, shows social media still prints money. But here's the billion-dollar question. Are we witnessing genius long-term planning? Or the next dot-com bubble in disguise? Controversy alert. When does strategic investment become irresponsible spending? Zuckerberg's $72 billion AI bet equals 15% of Iceland's entire GDP. Is this visionary leadership or corporate hubris? And could Microsoft's dominance actually stifle AI innovation by crowding out smaller players? As you digest these numbers, ask yourself, would you trust Zuckerberg with your retirement fund to chase AI dreams? Are we overestimating how quickly AI will transform industries? The market's voted with its wallet. Now it's your turn. Drop your take in the comments. Bold future building or dangerous FOMO spending spree?